This video relates to company analysis, which is the last part in the fundamental analysis part, or a final stage under fundamental analysis. So previously, after the economy analysis, we find that the investor gets a broad outline of the prospects of growth in the economy. Secondly, again, industry analysis, which has been done by the investor, helps to select the industry in which the investment would be rewarding. Now, the final thing is that the investor needs to understand which company he should invest his or her money. So, the company analysis uh, deals with the estimation of return risk of individual shares. So, where the company investor is going to invest, the investor needs to understand the risk and return relationship. This calls for information now. So this information actually can be collected from various sources, and which is available by way of websites, by way of annual reports, by publication in quarterly reports, by press conferences, etc. So this information influences the decision making of the investor, and this information can be both external and internal as well. So internal information consists are those which consist of data and events made public by the companies concerning their operations, so by press conferences, etc. And the internal information sources like includes like annual reports, shareholders, public and private statements of officers, etc. So external sources of information are those generated independently outside the company. So there are some organizations like even credit rating organization or even firms like Moody's and etc. They try to predict or they try to understand the potential of a particular firm, and they make certain uh, statements which can be used for investment purposes. So there are various ways through which the information can be collected, and this information can be both qualitative and quantitative terms. The qualitative is in the form of certain management styles and etc. These things needs to be looked upon. So moving on, there are certain features or aspects which needs to be looked into by the investor while making certain decisions of the company. So we have net worth and book value. Net worth means the sum total of share capital, that is preference shares, equity shares, reserves minus intangible assets, and book value of the assets or book value of the firm means the carrying amount of the assets are the book value. So the investor needs to understand what is the difference between the book value and the market value. Then we have sources and uses of funds. So how the funds have been collected by the organization, whether it is equity or debt, or mostly equity or debt, mostly debt or equity. So they have to understand if the firm is very leveraged, how they are going to pay the interest amount, or if the firm is highly financed by equity, or then how the firm is paying off its dividends. So they need to understand whether the firm is in a good liquidity position or not. Cross-sectional and time series analysis. Cross-sectional and sectional data or analysis means you have already studied this thing, that is comparative size statement, common size statement. These statements are prepared in order to compare the performance of a firm over a period of time or between two firms at the same period of time. Then we have size and ranking. Ranking means there are firms, like I've already mentioned, there's some external firms which rank the organizations, or the size of the firm also affects the decision making of a particular individual, because a very large firm obviously in the long run will have better opportunities of the market. So ranking and size is also a factor which affects. If the rank as per important organizations are higher, then obviously that particular company shall be one good opportunity for investment. Growth record, that growth record here we talk about how the company is growing over the years, whether or is it in a particular stagnant position. So the investor should understand or see the performance of turnover or sales in the previous years and then compare it with the current year. Financial analysis include the evaluation of various ratios, like we have liquidity ratio, we have leverage ratio, we have profitability ratio. So there are various ratios which need to be evaluated and compared with the previous years, and then try to make an understanding. Then competitive advantage here means whether the company is in a competitive advantage, or whether the company is in an advantageous position in the market or not. That means if there are number of companies producing the same type of item, how that particular company concerned is taking advantage of certain deficiencies of the other companies. So this thing is a qualitative aspect which needs to be understood. Then quality of management relates to how they are disclosing certain information. So this thing is basically qualitative in nature. You will find them, or the investor will find them in the annual reports or statements that are disclosed by the organization from time to time. There they will try to understand how the information is being disclosed, or what type of attitude is being taken by the management to implement certain policies, uh, like the risk management officer is there or not, or how they have recruited the risk management officer, what is his experience. So these things needs to be taken into account. Then corporate governance. So corporate governance is basically related to transparency of the firm, whether they have met the compliance of various requirements which are to be made from day to day. So this is or whether they are independent directors or not. So these things needs to be taken care of. Regulation here means the various regulations or rules and rules of the government which are required to be met by the company. Rules maybe, or regulations maybe by the Companies Act, SEBI Act. Then we have Securities Contract and Regulation Act. Then the stock market terms and conditions. These things should be regularly met, or else the firm may have to pay huge fines or even shut down its operations. Location and labor management relation. Location refers to the position or location of the firm near its raw materials. If it is so, if the firm is located very closely to its raw materials, then it is very good for the it is good for the company, because their transportation costs will decrease. As such, their cost at large will decrease, and their profit avenues will open up. And labor management relation means whether the management is treating the labor properly or not, or whether there are strikes, often strikes. So these things needs to be considered for before making an investment. Then we have pattern of existing stock holding. What type of shareholders have taken part in the company? How many corporate firms are taking or have shares in that particular company? So when the stock holding pattern is very proper, then obviously it is safer for investment. The marketability of shares means how the shares are being traded in the stock market, whether they're active or inactive, dormant. So these things need to be taken care of. If it is very active, it's very good. If it is not active, the investor should take care before making an investment. Next, we have techniques that are used in company analysis. Techniques include correlation and regression analysis, trend analysis, and decision tree analysis. So correlation and regression analysis here, correlation means whether the two important variables in the company analysis have any sort of relationship or not. Suppose we have sales and a particular expenditure. Suppose or profit in relation to the risk management or employee of, or a particular department in the company. Is there any relationship? Like if there is a relation, it will be positive. If there is no relation, it will be negative or zero. Then regression analysis may be done to understand the significance level of that particular relationship. Then we have trend analysis, whereby the investor can make a trend analysis of the performance of the company over the years, so that the investor can analyze at what point of time and why the company may have not performed well in a particular year, and why a particular company have performed very good in a particular year. So these things may be analyzed by trend analysis. Then we have decision tree analysis. So the decision tree analysis I have shown here with the help of an example. It's basically a possibility situation, whether if yes, they will follow a particular path. If no, they will stop right there. Or if no, they can again venture into something new. So if, like, if suppose the temperature is, or if suppose the weather is good That means if it is not rainy, they will venture out into the ground and play. And if it is rainy, then not they will play something inside the house. So this is basically a probability analysis whereby investors should make analysis of what should be the situation if they are thinking of an expected return of 12% maybe, and what should be the situation if they are expecting a return of 10%, and so on and so forth. So the investors should make a well-informed decision making before investing their funds into a particular company. So that is all about company analysis. Thank you.